Hey everyone, and today we are going to talk about two companies that seem to have good potential ahead based on their recent filings. So the first one is a major infrastructure player. It just backed two huge orders worth rupees 4,400 crores, one from Rajasthan Water Grid Project and the other from Gurugram Metro. And the second one is a leading auto dealer which has now stepped into luxury retail by setting up the brand new subsidiary. So basically, both the companies are expanding steadily, one by securing long-term visibility in infra growth and the other one by stepping into luxury retail to tap new revenue streams. So welcome to another episode of Noisemaker, where we keep things simple and talk about companies that may not always come in the spotlight but have a strong potential for the future. I'm Saijal, Equity Research Analyst at Desvelado Advisory, and today we are going to talk about two companies that are making solid progress in their business, and if current trends continue, they might keep growing even further. But before we begin, here is a quick disclaimer. So any discussion, facts or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So please conduct your own due diligence before making any investment decision. So now let's move to the first company. Dilip Buildcon Ltd, which is one of the leading infrastructure developers in India, mainly executing projects on an EPC basis. Recently, the company announced two big order wins worth rupees 4,456 crores, and the first one is the 2,952 crores Rajasthan Water Grid Project to be completed in 27 months, where DBL will construct a large feeder canal system and also manage operations for 20 years. And the second one is a 1,503.6 crores Gurugram Metro Project with a 30-month timeline involving construction of viaducts, elevated stations, and metro corridors to strengthen urban connectivity. Now, what makes these wins so significant is that together they account for over 50% of companies' FY26 revenue guidance of 8,000 to 8,500 crores, which provides very strong visibility for the next few years. And even more importantly, these projects have come after a muted inflow period as the government has tightened the qualification norms, effectively filtering out smaller players and giving an edge to established ones like DBL. And with this, the company has made solid entry into two high growth verticals, the water infrastructure and metro rail, both of which management had earlier highlighted as future growth drivers. So now Mudit will be joining in for giving us more information. So Mudit, how do you see these order wins impacting DBL's positioning and growth opportunities going forward?
Thanks, Cecil. I think these orders wins mark a strategic turning point for DBL. Traditionally, the company was heavily dependent on road construction, which made its growth closely tied to NHAI's project pipeline. But now, with meaningful entries in metro, rail, and water infrastructure, the DBL is diversifying into newer verticals where the growth outlook is equally strong, if not stronger. So take FY26 for example, right? The NHAI alone has outlined projects worth 3.4 lakh crores, while metro approvals worth 20,000 crores have already been announced in Andhra Pradesh. By securing, I would say, a foothold in these verticals early, the DBL is positioning itself to capture a much larger share of the upcoming tenders. Another positive thing here is that the time execution of these projects will not only help in driving revenues and sustaining margins, but they will also strengthen DBL's credentials for winning more complex, high value projects in the future. So, my question to you is so clearly, it's there's order inflow momentum and picking up, and is picking up again after a, a lull. So, so basically, I would say the order info momentum is picking up again after a lull. So, Cecil, how is this transformation reflecting in their financial performance so far?
That's a great question, Mudit. If we look at FY25 performance, revenue came in at 11,317 crores, which was actually down 5.8% year on year compared to 12 crores in FY24. And if we talk about quarterly numbers, they were also a bit volatile. Like for instance, Q4 revenue rose to 3,096 crores, which is up by 19.5% quarter on quarter. But then Q1 FY26 slips to 2,620 crores, which is a decline of 15.4% quarter on quarter. But here the interesting part is, even though the revenues moderated, profitability improved sharply. EBITDA jumped 51% year on year to 2,151 crore, with margins expanding from 11.8% to 19% in FY25. And if we talk about net profit, it also surged and more than fourfold to 840 crores compared to just 201 crores the previous year, lifting the net margins to 7.4% from just 1.7%. And this shows a strong operational leverage, better project execution, and much tighter cost control. And if we look ahead, management has also guided for 12,000 to 15,000 crores of order inflows in FY26 and expects the margin to remain around 11%. So profitability looks much more stable, Mudit. Now, do you think that their capital allocation strategy and debt reduction plans will further boost the investor confidence in the company?
Absolutely, Cecil. One of the most encouraging aspects of DBL's strategy right now is its clear focus on balance sheet strengthening. The company has announced plans to cut 500 crores of standalone debt by FY26, and it's targeting to become the net debt free by FY27. This is significant because historically, infrastructure players like DBL have struggled with high leverage, which often eats into profitability through interest costs. In DBL's case, the steady cash flow from its O&M contracts are providing the stability needed to support its deleveraging. So, let's say if we talk about as the debt comes down, the interest cost will fall, freeing up more capital to reinvest into growth. This will not only boost overall profitability but also make DBL financially stronger when bidding for larger and more complex projects, right? So, with that, if I want to sum it up, then with that, the DBL today is standing on four solid pillars. First, robust new order wins, diversification into the high margin and the high growth sectors like metro and water infra, a sharp margin recovery, and a clear roadmap to deleveraging. If execution stays on track, if it actually does, the company looks well positioned for a much stronger and more sustainable growth trajectory over the next few years.
Okay, thank you, Mudit. So now let's move to the second company, which is Landmark Cars Ltd, and it's among India's leading premium auto retailers with over 115 outlets across major cities. And they have partnered with top brands like Mercedes-Benz, Honda, MG, BYD. And in FY24, they reported revenues of 3,288 crores. Now, the company isn't just expanding its presence in new cars, but it's also actively expanding its pre-owned segment. Recently, Landmark incorporated a wholly owned subsidiary called Landmark Luxury Retail Private Limited by investing small equity of 1 lakh rupees, and this entity hasn't yet started its operation, but it intended to operate in the luxury retail trading space. And the move reflects Landmark shift towards the premium and luxury segment, something that's already visible in the numbers as well, with new premium brands contributing 19% of revenue in Q1 FY25 versus if we see the FY25, which is 13%. And interestingly, BYD has now become their second largest contributor as well. So, Mudit, how do you see this move into the luxury retail impacting Landmark's business model and growth prospects?
I think this is quite a strategic pivot for Landmark. Like, if we talk about traditionally, then their business has been tied to auto dealerships, which are inherently cyclical and margin sensitive. So, by entering luxury retail, they are looking to diversify revenue streams beyond the automobiles and leverage their strong base of affluent customers who already buy premium cars. Right, so I think this is kind of a smart because it complements their existing strengths like dealership operations, after sales services, and brand partnerships. And so, like if executed properly, the luxury retail venture could create a profitable new growth avenue, one that's less cyclical than the car sales. And when you combine that with their ongoing shift towards premium brands like BYD, MG, and Kia, then it positions Landmark to grow faster than the overall auto retail industry. But Sejal, what do the financials tells us about the current performance and the challenges that they are facing?
That's the critical point, Mudit, because in FY25, Landmark Cars delivered 4,025.5 crores revenue, which was a strong 22.4% year on year growth, compared to 3,287.9 crores revenue, which was in FY25. However, the quarterly momentum wasn't very consistent. Its revenue peaked in Q3 FY25 at 1,195 crores, but then it slipped in Q4 by 8.7% and again dipped 2.7% in Q1 FY26. And the real concern is profitability because EBITDA stood at 234.9 crores in FY25 with margins compressing to 5.8% from 6.9% in FY24, and net profit dropped sharply to 17.3 crores compared to 57.2 crores the previous year, bringing the net margins down to just 0.4% versus 1.7% earlier. So, despite strong top line growth, earnings were under pressure, clearly due to rising operating costs and pricing pressure. And going forward, Landmark will need to focus heavily on the cost efficiencies and margin recovery to convert the revenue growth into sustainable profitability. So, Mudit, given this margin pressure, how do you view their long term positioning and market share ambitions?
Right. So Cecil, that's where it actually gets interesting. Right now, if we talk about that, the landmark holds only about 0.5% of the India's PV market by volume and 0.8% by value. But the marathon aspires to double this market share over the next few years. They draw parallels with China, where their leading auto retailers command around 1.5 to 2% share, and they see similar consolidation potential in India. So to support this, the landmark is expanding aggressively into the fast-growing brands like Kia, MG, Mahindra, and BYD, while continuing to scale outlets in premium and luxury segments. So if we talk about the upcoming Kia and MG launches are expected to boost volumes and drive growth, which will support their long-term PAT margin guidance of 2 to 3%. Another key driver, if I talk about that, then it will be the after-sale business. For older brands, after sales contribute about 17% of revenue, but for newer brands, it's only still 9%. So as these outlets mature, after sales will become a bigger profit contributor, which naturally carries higher margin. Add to this, I would say the expected cost efficiencies from scaling operations, and Landmark has a credible path toward margin expansion and more stable profitability. So overall, Landmark, I would say, it's building a multi-pronged growth story, which is basically which actually I would say includes a premiumization of auto sales, diversification into luxury retail, expanding after sales recovery, and targeting market share gains as industry consolidates. Right. So the thing is, if they can actually execute on both growth and efficiency, the company could position itself as a dominant player in India's premium auto retail price.
Okay, thanks a lot, Mudit. That really helped us to understand the direction both these companies are moving in. So, now let's take a quick look at how some of our previous picks have performed. Vimta Labs Limited from 481.5 rupees to 664 rupees, and that's a gain of 37.9%. Jupiter Lifeline Hospitals Limited, this one slipped from 1499 to rupees 1421, which is a decline of 5.2%. Late Travenues Technology Limited, it moved up from 194 rupees to 275.5 rupees, delivering a strong 42% return. MAS Financial Services Limited from 324 rupees to 307 rupees, which shows a drop of 5.2%. And lastly, we have Alpex Solar Limited. We picked this up at 1205 and now it's at 1324.9, giving a return of 9.9%. Continue to monitor all these companies closely to see how they shape up in the coming quarters. Now here is the QR through which you can access all the previous picks which we covered recently. Now let's move to the summary of today's companies which we included in today's Noisemaker. Dilip Buildcon Ltd, the company recently announced two major order wins totaling 4,456 crores, one from Rajasthan Water Grid Project and the other one from Gurugram Metro Project. Second is Landmark Cars Ltd, where the company has incorporated Landmark Luxury Retail Private Limited as a wholly owned subsidiary by investing 1 lakh rupees in equity capital, thereby holding 100% ownership. So that's it for today's edition of Noisemaker, and if you found this breakout informative, you can scan the QR code to read the full report, and we'll be back soon with more simple and clear market updates. Until then, stay curious, stay ahead and stay informed.